Sustainability also requires management. There are five aspects or areas that could be used for sustainability management: environmental management systems, environmental management accounting, using life cycle analysis and costing, capital budgeting, activity based budgeting, activity based costing, and balance scorecard. Environmental management system manage its environment impact effectively. An enterprise must engage in the necessary management activities of planning, control, and evaluation. There are various standards exist to identify and benchmark key aspects of environmental performance. For example, the ISO 14001 and ISO 14004 are used by all enterprises in Australia and around the world. Blue Scope Steel's environmental management system highlights the importance of translating broad values of the enterprise into specific implications for day-to-day operations. It starts with its vision, policy, then outlines principles, then standards, then the corporate policies, procedures, and code of practice and guidelines, then the business and sub-business policies, procedures, codes of practice, and guidelines. Second is environmental management accounting. That is to supplement the cost accounting system by providing information about environmental impact of the enterprise's activities. Specific tools including life cycle costing, which is similar to life cycle analysis, but here with a focus on measurable costs and full cost accounting. There are various ways of including cost management, such as activity-based costing, to separate out the environmental costs. Although often more than 30% of enterprises' resources are wasted, those costs are included into the product cost. This effectively hides the waste and leads to incorrect pricing. The solution is to separate the waste cost so that the enterprise can focus on waste reduction. There are various ways in which environmental objectives can be included in cost management. One of them is life cycle analysis and costing. Life cycle analysis evaluates a product or service over its life. Life cycle cost, on the other hand, focuses on the financial costs incurred. Life cycle analysis begins to recognize some of the social and environmental impacts that can't be costed, such as the amount of carbon dioxide associated with production and use. The move to life cycle analysis is broadening the focus from value generation for a limited group of stakeholders to recognizing cost throughout the product or service life cycle. It's impossible or inappropriate to put a dollar amount on the cost imposed. So life cycle analysis may focus on other measures such as the quantity of toxic emissions. The third is to use capital budgeting towards environmental objectives. It can create cost savings for enterprises and its customers. The cost savings to customers can provide a basis for negotiating higher prices. Some important impacts, for example, are the competitive advantage of reusable shipping containers in relation to employee safety. Risk is also an important factor in capital budgeting decisions. For example, reusable steel shipping containers for transporting toxic materials may reduce the risk of a spill with its associated fines and impact on reputation. Fourth is the balance scorecard to manage costs. Management accounting tools adapted to pursue social and environmental objectives. For example, a balanced scorecard methodology can be used to map and manage interrelationships and drivers of social, environmental, and economic performance. Fifth is justifying environmental performance economically, that is, to recognize all potential cash flow effects of the enterprise. Environmental impacts is impossible, but increasing awareness is very important. The share price for a listed company is determined by its anticipated cash flows and the risk associated with these cash flows. Enterprises have an incentive to demonstrate to the market that they have effective systems in place to manage cash flows. That includes environmental performance. The Pareto principle states that 20% of production activities are responsible for 80% of environmental costs. The quality management approach, in which costs are categorized and applied to managing environmental impact, includes prevention, appraisal, internal failure, and external failure. Strategy for sustainability is to shift enterprise strategy as required to change its culture that infuses throughout the organizations. It also must learn for sustainability as an ongoing project. Total quality management also applies to sustainability as a journey rather than a destination. The objective of sustainability are unlikely to be completely met, but they provide a goal to continually to strive towards the emphasis that is placed with a rate of change. There are tools for social and environmental issues, planning tools to assess environmental impact, strategic impact, assess the risk, and cost-benefit analysis. There are also tools to assess impacts on operations, such as ISO 14000 series. There are also common product and process design tools for environmental design and life cycle assessment. The monitoring and evaluation tools to monitor energy, waste, health, safety, audits, and benchmarking